Hi everyone! Welcome to our Smart Learning video note for corporate finance. Today we're diving into one of the simplest but surprisingly powerful capital budgeting tools, the payback period. To make things fun and easy to understand, we've created a mini corporate scenario featuring a fictional company called SolarBright Corp. Before that, let's meet the key members of SolarBright Corp. Who will be involved in evaluating this investment decision.
Hello, my name is Dika. I'm the CEO of SolarBright SDN BHD.
Hello, my name is Sophia. I'm the CFO of SolarBright SDN BHD.
Hello, my name is Faiz. I'm the production manager.
Hello, my name is Rizky. I'm a financial analyst.
The story also involves the company's board of directors, who are responsible for reviewing major investment proposals and making the final decision for the company. Now, sit back, relax, and let's jump into the story.
All right, team, thank you for coming on such short notice. I know it's early.
Boss, it's already 11 a.m.
Morning, Anyway, we have a problem. Customer orders are going up, but the production is moving like a snail on Monday blue skies. If this continues, we risk losing major clients. Our competitors already upgraded their production lines. We'll fall behind if we don't act fast.
Honestly, our assembly line is so slow, I think my grandma can build panels faster.
Sir, I have a solution. There's an automated solar panel assembly machine. Fast, efficient, zero mood swings. Don't complain. Doesn't need lunch.
Okay. I'm listening. So, how much?
Around 1.2 million ringgit.
Hey, Faiz. Do you think we own an oil company, huh? Before I pass out, finance team, please check whether this 1.2 million ringgit monster machine is worth it. And no textbook theory. I want real numbers, real reality.
We'll use the payback period. It's simple, straightforward, and doesn't give us migraines.
Every project feels like a group assignment with no due date. But it's okay. We can do it. Guys? Faze, give me the estimated cash inflows from this magical machine.
Here it is. Year 1, 300,000 ringgit. Year 2, 250,000 ringgit. Year 3, 220,000 ringgit. Year 4, 200,000 ringgit. Year 5, 180,000 ringgit. Year 6, 150,000 ringgit.
Not bad. Okay, time to start some calculation therapy. Initial investment, 1,200,000 ringgit. Now we calculate the cumulative cash flows. By the end of year 5, we're still short of 50,000 ringgit. So, to recover the remaining amount, it will be 5.33 years. Basically, this project pays back just in time for retirement. Barely.
What? 5.33 years? That's too long. The machine only lasts 6 years, meaning we enjoy actual profit for, what, 8 months? My gym subscription lasted longer than that. This payback period exceeds the company's 4-year cutoff. Financially, this is considered high risk.
Exactly. It's risky. One bad sales month and boom. Disaster.
All right, let's pause for a second. 5.33 years means we recover our money almost at the end of the machine's life. That means one delay, one unexpected repair, and we're already in trouble.
Exactly. Financially, this gives us very little margin for error. If cash inflows drop by even 10%, the payback stretches beyond the machine's useful life.
And the payback method doesn't even consider the time value of money yet. This is already the best case scenario.
The numbers are clear, but the implications are heavy.
From an operations point of view, Project A solves the capacity problem. It increases output by more than 40%. No overtime, no backlog, no angry customers. But if sales fluctuate or the machine underperforms, the risk is high.
So it's powerful, but fragile.
That's a good way to put it, sir. Operationally strong, financially sensitive.
If everything goes right, we're heroes. If something goes wrong, we're explaining losses to the board.
A solution that fixes one problem may quietly create another.
Project A gives us capacity but fails the payback rule. Project B passes the payback test but cannot meet customer demand.
So whichever we choose, we compromise something important.
Project A risks our cash flow. Project B risks our reputation and customer loyalty.
And losing customers is not something we can easily recover from.
But losing cash can shut the company down completely.
This is the classic investment trade-off between risk and performance.
At this stage, neither project fully meets the company's requirements.
Which means we shouldn't rush into a decision.
If we move too fast, we might regret it for the next 6 years.
But if we wait too long, we risk falling behind competitors.
So we're stuck between acting too fast or waiting too long.
Just as the team reaches an impasse, new information begins to emerge.
However, Project B, the cheaper semi-automated upgrade, also faces problems. It recovers fast, but it only increases production by 20%. Customer demand, however, has increased by 40%, meaning even if we choose Project B, the company still cannot meet customer orders. With 20% subsidy equals 20% times 1,200,000 equals 240,000 ringgit. New cost equals 1,200,000 minus 240,000 equals 960,000 ringgit. Cumulative at end of year 3 equals negative 190,000. However, the year 4 cash inflow of 200,000 ringgit covers the remaining amount.
So, both projects have issues? One too slow to pay back, and one too weak to handle demand.
Wait! I just received an update. There's a government grant for renewable energy automation. It can subsidize 20% of Project A.
If that subsidy is approved, the payback period drops significantly. That changes everything.
All right, finance team. Tell me the truth. Should we buy the machine?
Here's the situation, sir. Without subsidy, payback, 5.33 years. It's too long and fails limit. With subsidy, payback becomes shorter and closer to our 4-year requirement. This is like buying a brand new phone. Then when realizing it becomes outdated 2 months later.
Not good enough without subsidy.
So, we get our money back almost at the very end of the machine's life?
Correct. It's basically a recover your money at the last minute kind of project.
That sounds like my cousin who pays his phone bill 1 hour before they cut the line.
But realistically, this is risky. If sales drop or the machine breaks down, we only have 8 months of profit. That's shorter than my last relationship.
Exactly. A single bad year and the whole project collapses. One thunderstorm, one supply issue, one technician sneezing. Boom, we're in the red.
I'm sorry, but that's a big no from me. I prefer investments that recover fast, not ones that make us hold our breath until year 6.
Okay. Everyone is clearly united. Let's move on before the stress level makes our coffee machine resign. As much as I want that futuristic robot-looking machine, we cannot take the risk.
All right, I'll find something cheaper. Maybe a used machine. Maybe somewhere online?
Here's what we learned today. Payback period shows how long an investment takes to recover. SolarBright's payback was 5.33 years, too close to the 6-year lifespan. Project A is risky without subsidy, and Project B cannot meet customer demand. Final corporate recommendation: proceed only if subsidy is approved. Thanks for watching! And remember, if an investment pays you back slower than you finish your degree, just don't buy it.